So a lot of bearish options seem to have went into Tesla stock in the last half an hour or so of trading. These are your large investors. Take a look at these trades. Oh my gosh, it just gets worse when you look at it. January 19th, 2024, 450 put for $123 million. Say what? Boy, do we have a crazy video to get into today. We have big data coming out tomorrow morning. We got big data today. The bonds moved huge. I mean, what in the world is going on in the bond market? We might have a couple different answers here. One scenario that could be playing out is pretty dang bullish for markets. One is, yeah, not so bullish. We also have an Israel war update. As you guys know, this is the single biggest catalyst right now that could cause the markets to drop 10 to 20% if the situation does get worse. So I want to make it a point to update you guys every chance that I get so you are informed to the utmost degree. Now, on top of that, we're going to get into what is coming next with Tesla. Holy moly, in the land of options. That last half an hour or so of trading is crazy. Tesla seen over $1 billion worth of option activity, a lot of which was in that last 30 minutes or so. So we have a lot to get into in a very short amount of time. If you own Tesla stock and you like this stock, hit the like button, as well as subscribe to the channel if you guys want to stay up to date with all of this information each and every single day. So let's start with the Fed minutes. This is basically a report or a summary of that last Fed meeting that happens for 2 days before we get the FOMC press conference. In this case, it was September 19th through the 20th. A majority of participants judged that one more increase in the target federal funds rate at a future meeting would likely be appropriate, while some judged it likely that no further increases would be warranted. The document noted that all members of the rate-setting Federal Open Market Committee agreed they could proceed carefully on future decisions, which would be based on incoming data rather than any preset path. So they're reiterating again that they are data dependent. And again, they do reiterate policy should remain restrictive for some time until the committee is confident that inflation is moving down sustainably towards its objective. Now, some Fed officials have a little bit different take on this. Take a listen to Fed Collins and what she said on CNBC today.
Boston Fed President Susan Collins making some headlines. Steve Leisman has the highlights on the Newsline. Hi, Steve.
Hey, Morgan. Yeah, Boston Fed President Susan Collins saying inflation's still too high, but the Fed should take its time to assess incoming information. So she becomes one of a series of Fed officials who doesn't sound like she's in a big hurry to be raising rates right away. She says the Fed is likely close to the peak of the tightening cycle at this point, something that was talked about in the minutes of the September Fed meeting. Further tightening could be warranted, though, depending upon incoming information, so she's not ruling it out. The risk of high inflation, she says, is more closely balanced with the risk of slowing activity. Another kind of echo of the minutes that we heard earlier today about the idea that risk is two-sided, and there's concern in the minutes you heard about some downside risk to the economy. She goes on to say that the Fed will need to hold rates at a restrictive level until inflation heads back to the 2% target. And she's optimistic price stability can be restored, quote, with an orderly slowdown, she says. It does not include a very large increase in the unemployment rate. The minutes, of course, guys, came out today before the recent rise in rates, and majority in those minutes wanted to raise rates a second time. But now we hear a lot of folks talking about the rising yields and how much that means for the Fed, and the idea that it could be doing the work for the Fed. And I'll leave it there and let you guys ponder how this will affect Q sales.
Oh, we will indeed. Higher for longer still, it sounds like, but maybe not much higher immediately. Steve Leisman, thank you.
I think it's important to point out that these Fed minutes are from September 19th and September 20th. Today it's October 11th. Since the Fed minutes, since their meeting, Treasury yields rallied hard after the press conference and Fed Jerome Powell, which was the 21st of September. So their opinions have changed pretty dramatically. As Steve Eisman said from CNBC, you've seen a change in tone from a lot of Fed speakers. The work has been done. It looks like we're not going to get any more interest rate hikes, but it also doesn't look like they're in a rush to start cutting rates. So we have two potential situations that are playing out for the markets right now. As you know, bond yields have been coming down over the past couple of days. This could be, if you're in the bullish camp, because, well, now the markets are sitting here saying, hey, if the Fed is done raising rates, they usually start to cut rates in the not too distant future. That maybe the bond market is starting to price that in. That is certainly a possibility. That would be bullish for stocks. The second thing that could be happening to yields, in which I've spoke about this before, but I want to give you a little bit more to go off of. And it's the simple fact that investors are buying bonds because they are fearful. Now, why are they fearful? You could say maybe the economy is about to slow down in a big way. We're heading into recession. That looks pretty unlikely right now. Even if we go into recession, it's probably not happening right now. Maybe it is. Who knows? The government data is very delayed. Odds are you are seeing investors buying bonds because big money is fearful on this Israel situation. If this does expand, it could have a real monetary effect on the globe, essentially. 30% of the world's oil flows through the Strait of Iran. I know I've said this many times, but I think it's important to point out. If investors are buying the bonds because they are fearful that maybe there could be a shock to energy that could push us into a recession, or just global conflict with large militaries is just never a good thing. Historically speaking, that has caused drawdowns of 10 to 20% basically every time you have seen a major conflict. So when there is fear out there, investors, long story short, will buy bonds. Now, what we've seen today was PPI came in much hotter than expectations across the board. Core, headline, month over month, and year over year, everything came in hotter than expectations. And what happened? Bond yields fell. In theory, bond yields should have risen on that, or at least stayed flat, because that's saying, hey, the Fed's not going to cut rates anytime soon. That's why tomorrow will be so important, and I do expect a pretty big move in the markets. We are going to get your CPI report. Now, on your CPI, month over month, on your core, you're expecting 0.3%. Last month's reading was 0.3%. You're not expecting much of a change here. Now, your core inflation rate year over year is expected to fall from 4.3% last month to 4.1% this reading. Technically, it's for August, 4.1% for September. Now, on your inflation rate month over month, you're expecting 0.3%. That will be down sharply from 0.6%. And your inflation rate year over year, you're expecting that to fall to 3.6%. Last month's reading was 3.7%. Now, a lot of people are talking about your super core. Now, that's really the service compartment of your core, right? So you don't want to see that running hot. If that comes in hot tomorrow to the same degree as the PPI, it was much hotter than expectations, and the bonds go down again, that is going to be confirmation that the bond market is fearful. The bond market is not buying bonds because they think inflation's coming down, or they think the Fed's going to cut rates anytime soon, or the economy deteriorates, forcing the Fed to cut rates. So let me summarize this in a little bit of English. Again, two things that are happening right now. Either Fed officials are sending the message to markets that they're about to cut rates, and that's why investors are buying the bonds, pushing down yields, or investors are buying the bonds, pushing down yields because they are fearful and they want a risk-free return. If tomorrow's CPI report comes in hotter than expectations, especially on your super core, and the yields come down, that's telling you investors are just fearful. This has nothing to do with Fed policy, has nothing to do with anything else. That's what you really want to be watching. Of course, we'll keep you up to date with all of that information and summarize it in an easy way to understand. Hopefully, we're doing that here in this video. Hit that subscribe button if you guys want to be notified every time a video comes out. Hit that notification bell. And again, let me remind you to hit the like button because it is free 99. I should also point out that when we started to see this bounce, the RSI was close to some of the lowest levels it has been at since the October lows in 2022. The RSI is now at 58.26. So especially if we get a hotter than expected CPI report and bond yields come down, you want to be very, very cautious here. I've said it before and I'll say it again. The bond market tends to know better than the stock market. The stock market, 70 to 90% of trading happens through algorithms. So if bond yields are falling for whatever reason, it's logical that algorithms would be buying stock because they can't necessarily tell the difference between fear buying of bonds and buying of bonds because they expect rate cuts or Fed policy to be easier, or maybe the economy to deteriorate and rate cuts in the future. So this could be an algorithmic move. That's what it looks like to me. So we'll see what happens with the data tomorrow. I personally think if PPI came in much hotter than expectations, CPI at least is going to come in a little bit hotter than expectations. Maybe quite a bit hotter than what people are expecting. Subsequently, I do expect a very large move for the markets coming tomorrow. Now, let's get into this Israel war update here briefly. So, the U.S. State Department warns Americans to reconsider travel to Israel. Another headline says Biden offers warning to Iran to be careful following the Hamas attack on Israel. He said, quote, "The U.S. is surging additional military assistance to the Israeli Defense Force, including ammunition interceptors to replenish the Iron Dome. We moved the U.S. carrier fleet to the Eastern Mediterranean and are sending more fighter jets there to that region. And make it clear to the Iranians, be careful." Benny Gantz, a former defense minister who joined the Israeli Prime Minister Benjamin Netanyahu, I seriously can't say that, and current defense minister Gallant in a war management cabinet said Wednesday that the three standing together is a clear message to our enemies. The state of Israel is at its most difficult hours. These are faithful days, Gantz said during a televised address. At this time, there is only one group, one camp, the camp of the nation of Israel. It looks like tensions are really starting to ramp up. Who knows what is ultimately going to happen? Hopefully everything is just fine and Israel does what they need to do. They eradicate Hamas. That's what they just said. And we can all get back to normal after that, at least some degree of normal. And this is not a bad event for the markets. But there is, again, that possibility this could turn into a serious crash for our markets. Israel's prime minister said every Hamas member was, quote, a dead man after the first meeting of his country's emergency government. Alongside him, opposition figure Benny Gantz said it was a time for war. Mr. Gantz told Israeli citizens that the newly formed government was, quote, united and ready to wipe this thing called Hamas off the face of the earth. So what you really need to be watching as equity investors, hopefully you guys are not in Israel. If you are, be very careful and my prayers go out to you. The thing you really need to be watching is when Israel does make their way into Gaza. That could be tonight. That could be a week from now. That could be multiple weeks from now. When that happens, that does open the door for a we're saving our people kind of moment for an Iran to get involved, or for a Saudi Arabia to get involved, or any of these other hostile nations that don't exactly want you destroying a Palestinian terrorist organization. But as an equity investor, Iran's really the thing you need to be watching here because of the effect on oil. If the U.S. gets involved at all, it's probably not going to be great. But if Iran and the U.S. were to get involved in an actual conflict, that would be the big problem. Hezbollah, sure, they have 140,000 missiles. They could also be a big problem. But that's not necessarily going to affect the flow of oil. That's probably not going to have a huge monetary effect on the markets, or for oil specifically. Let's now get into some Tesla stock news, as well as the breaking news coming out from the UAW here tonight. The UAW launches a new strike against Ford's Kentucky truck plant, signaling a major escalation in the labor fight. This Kentucky truck plant produces the Ford Super Duty pickups, as well as the Ford Expedition and the Lincoln Navigator. That means 8,700 Ford workers just walked out on strike today. It looks like Tesla stock might be reacting positively to this news. We'll have to wait and see. Tentatively, Tesla stock is up 0.18% here in overnight trading. Tesla was down about 0.06% before this announcement was made by the UAW to strike this specific Ford plant in Kentucky. According to a poll from IPSOS and Yahoo Finance, 57% of respondents answered that they are not likely to purchase an EV as their next car, with cost, driving range, and a lack of charging stations among their top concerns. The poll also found the car brands respondents would consider the most if they purchased an EV are Toyota at 30%, Tesla at 23%, Honda at 20%, GM at 15%, and Ford at 14%. Sawyer Merritt has the same question that I have. Toyota above Tesla? That's just strange. Pop-Up Motors shows off their new $15,000 5-inch lift kit for the Tesla Model Y, and I actually like it. I think it looks pretty dang cool. Let's see if you get better shots of that. I mean, it looks pretty dang cool if I were to say so myself. You could definitely do some off-roading, as you can see here. Take a Tesla mudding. Yeah, I never thought I would have seen that anytime soon. As far as Tesla option activity, something very weird happened. Let's just call it that. Today, you've seen 699 orders totaling $1.47 billion with a positive order value of 38%. In the video that we posted earlier, just so you guys know, I tried to end recording about 30 minutes before the closing bell, so around 3:30 p.m. to get you guys just the most latest up-to-date information. And what I found is the option flows really change that last 30 minutes or so. And what you're seeing now is a positive order value of 38%. In the prior video, check it out if you guys have not already, there was like an 82% positive order value. So a lot of bearish options seem to have went into Tesla stock in the last half an hour or so of trading. I find this quite strange, and again, more concentration around this January 19th 2024 put, targeting anywhere between the $400 put and the $475 put. These two trades for the $400 put was about $61.5 million. This one at the 416 put was about $69 million. This one was a $30 million put at the 450, another $61.5 million put at the 416, and at the 450 put, there's another $45 million trade. And take a look at some of these larger ones as well. Another $56 million trade, another $19 million trade, a $20 million trade, a $38 million trade, multiple trades that are in the $5 to $10 million range. These are your large investors. Take a look at these trades. Oh my gosh, it just gets worse when you look at it. A January 19th, 2024, 450 put for $123 million. Say what? That's the biggest negative option trade I've seen in a single trade ever on Tesla, or at least for a long time now. The 416 put, you did see a trade right here of $101.5 million. Another $121 million trade. Maybe someone knows something. Maybe someone knows CPI is going to be just really hot, or something is about to hit the fan with Israel. Those are some very strange trades, okay? To see anything over $70 million is like a multi-billion-dollar hedge fund, like $100+ billion firm that is making that trade. That is not a small fry that is placing these trades. As you guys likely already know, Tesla is at a very interesting spot as far as the charts. You're right under your 265 resistance level. This is a longer term downtrending line. If you break above that, you're going to be in for an even larger rally. I would imagine breaking out pretty easily above $300 per share into the 320 to 350 range, especially if we get some news on the Cybertruck and there's a reason for the stock to move higher. You're at a very important level. on the upside. For the downside, your 50-day moving average and your 100-day moving average is sitting right at about $250 per share. So if you do get downside, it's probably to that level. If you fall under about 140, which is right where this uptrending line of support does meet the prior support level, which was around 240, that was back here, coincidentally where your 100-day moving average was at the time. This was in late September. 240 should be coinciding with, again, that uptrending line of support and your prior strong level of support as well. So 240 is going to be a big level for the downside move to find support. If you don't find support there, it's probably going to be pretty easy to fall to about 210. So if you get above 265, a close into the 270s, you're probably in for a much larger rally, especially if you get really good news, especially if it's the Cybertruck or earnings that cause that move higher. Vice versa, to the downside. If you break under 240 and you don't hold support at 250, then you're looking at deeper downside, likely at least, at the bare minimum, to that 200-day moving average. Now again, this option activity looks like someone knows something. So I don't know if there's going to be news, if something negative is going to happen. I don't know. I'm not going to speculate that far for you. But this was unusual option activity. We'll just leave it at that. So that is going to go ahead and do it for this video. Hit that like button and subscribe to the channel if you guys want to stay up to date with the latest information that hopefully helps you make more money. Subscribe to the channel as well. Hit that notification bell if you guys have not done so already. If you guys would like to come trade with us live in real time, no matter which way this baby goes, up, down, sideways, left, or right, you are going to make some money over there with us. I'm not a financial advisor. I'm not a financial planner, but we are hedging out our portfolios for the downside. We are leveraging our portfolios to the upside as well in a safe, secure way that can be pretty much copied and mimicked on any size and scale of anyone's portfolio. So again, I'm not a financial advisor, but I do send out my trades every time I make trades, give you guys a little bit of a sense of what I'm doing with my position, my portfolio in Tesla, as well as other names. We do day trades, swing trades, spreads, we do iron condors. We get into some things over there. So if you guys want to be a part of the action, link down below in the description of this video. Again, if you guys don't already know, my name is Michael Tyler. Enjoy the rest of your day, and I will see you in the next one.